Money Talks.
Money Talk.
Money Talks. Money Talks.
Hi, my name is Ibukun Oyedeji, President CFA Society Nigeria. Join me and a host of other financial industry practitioners for Money Talks with CFA Society Nigeria.
Money Talks.
Money Talk.
Money Talks. Money Talks.
Money Talks with CFA Society Nigeria. Let's talk about money.
Hello everyone and welcome to Money Talks. Money Talks is brought to you by CFA Society Nigeria and it's a financial literacy program, SMART. Uzechi is my name. You can call me Captain Smart and you will be financially correct. Today on the program, Abiola Hammed leads the capital advisory team at Ava Capital Partners Limited, where he leverages his extensive experience in treasury and capital markets to drive significant growth for both retail and institutional clients. With a strong background in developing innovative financial solutions, Abiola has successfully managed complex transactions in both public and private markets, consistently delivering value and strategic insights that enhance client portfolios. Abiola is a chartered financial analyst, CFA charter holder. He holds a master's degree in energy economics from the University of Ibadan and a bachelor's degree in zoology from Obafemi Awolowo University. Abiola Hammed, CFA, is my guest on the program this evening. Abiola, good evening to you and welcome to the program.
Good evening, Smart. Good evening, everyone at home.
It's so good to have you. You look like a lawyer.
I try to represent.
Hey, that's represent them. Good to see you. Welcome to the program.
Yeah,
how you doing?
I'm very fine.
How's the financial sphere?
Well, a lot of flux, but we're right there.
Okay, that's good. Abiola and I will be talking about capital allocation for retail investors. Right way to think about your money, investment, and credit. That's what we're about this evening. You can be a part of the program by calling us on the telephone number 0700 923 923 923. That's 0700 923 923 923. You can also send us messages on WhatsApp 0817 313 6193. Or you can look at the website of CFA Society Nigeria, www.cfasocietyng.org. All across the social media platforms on X, on YouTube, on LinkedIn, on Facebook. You can find CFA Society there at CFA Society NG. And you can send us messages, give us your feedbacks and reactions. We would love to hear from you this evening. Whatever you do, be sure that you're getting in touch as you participate on the program. We'd love to hear from you live here in the studio. Don't forget, you can call 0700 923 923 923. There's also 0817 313 6193. You can send WhatsApp messages there or record voice notes and send to us as we talk about capital allocation for retail investors. Right way to think about your money, investment, and credit. So, Abiola, can I start by asking you what capital allocation means for a retail investor, and why is it so important to think about this not just anyhow but strategically?
Okay, thank you so much, Smart. The word itself, capital allocation, is a word we use in the corporate sphere, right? What we try to do now is to draw a parallel for our individual investment and lifestyle, right? So when we talk about capital allocation for the corporate sphere, we talk about how companies drive value from the allocation of resources. And for individual now, we are talking about how you deploy your income to build wealth and to sustain your lifestyle, right? How also you think around your finances in terms of the balance sheet and also the income, the flows, and how you retain some of these flows to accumulate for yourself. Then you can display your balance sheet in terms of asset building, how you think about your loans, liabilities, and what you retain for yourself as equity in your personal finance.
Brilliant there. So having said that, how can someone now determine the right balance? You know, people are talking about short term, medium term and long term investment. So how can somebody strike a balance, amongst these, short term needs? When you're looking at emergency funding there, you never expected this was going to happen. Boom, someone bashes your car, or there's a health emergency there. And then those long term investments, like, I mean, you're going to grow old. You're not going to work every day all your life. You're going to retire someday. So how do you strike a balance?
Okay, so first off, it's a personal journey. You need to understand that, okay, you just take a template of somebody. You have your personal journey so your design should be for yourself. So the first thing is that conscious decision that I want this kind of lifestyle. So you can start from you work your way backward from what you want to lifestyle you want to live for yourself, and then say, okay, this is amount of money or the kind of lifestyle I want to engineer for myself. How do I get there? Oftentimes also I'll also suggest that financial discipline, right? And like you said, those emergencies that come around, a lot of instruments are also what you should utilize, right? For your insurance should be there. Those kind of health insurance should be there, because those that's you catering for those emergencies that can set you back 1,000 or 100,000, right? So those tools are what encompasses what you think around the tools for capital. And also the way the money works is it's that's wings, can fly away, right? So oftentimes you deploy this capital with parachute, right, just so that you have a safe landing. So all of this, it's something you then consciously design. So I also advise that you measure where you are. This is where I want to be. This is where I am right now. I'm actually driving toward that goal. And don't be you can get sucked into the sunk cost fallacy, right? If what I'm saying is not what I desire for myself, I should have that humility and that self-consciousness to make a U-turn, right? So those kind of encompassing, and also have to have that conscious decision towards this is the lifestyle I want to live for myself, and these are the way to get there.
The parachute you mentioned, does it denote some kind of a risk in doing these things you're talking about?
Yeah, so those are risk mitigants, right? So I probably bought a particular bond, or let's say a financial instrument. So probably I need to cover myself, right? I have some layer on top of that, some derivatives, just so that if there is a downward decline in the value, I can make some offsetting returns on the derivatives I've layered on top of this instrument. So those are the kind of things you think around this kind of instrument. Deploy your capital, make some parachute. In case of emergency, you can deploy that parachute.
So talking about this investment now, let me ask you the types of investment vehicles that somebody can deploy, like stocks, bonds. There's real estate on one hand, and they have mutual funds there. What should somebody do? Should retail investors consider, based on their risk tolerance? We said that here because everybody you see out there, they don't tolerate risk at the same level. So how do they do that?
Definitely. So first off, when you want to think around this instrument, I strongly advise you seek a financial planner, right? It's very important. All of us, we've read report on health, but we don't treat our son or our kids at home. Right? It's very important for you to engage a financial planner. However, for instruments, these instruments have their own peculiarities. So if you look at the fixed income space, the bond market, what you are looking in that space is that the characteristics of this instrument that is a contractual. So there is a contract that is backing this. That means that the obligor is or the issuer is liable to pay you no matter what happens. In that case, also, as you are entering, you have the coupon that you know that this is going to be your interest on that instrument. So what you are trying to do in that space is to avoid losers, avoid those people that you give your money to and they will not return the capital, probably fold up, right, in that space. And if you look at the return you are expecting in that space, your coupon, capital gain in case there is movement in the yield curve, and also if it is foreign bond, you can say some FX translation gains. On the stock side, because there's no contract, so you can buy a bond, a stock at 20 naira, it goes down to 1 naira. hey, there's no.
You lost your money.
Exactly. So in stock market, what you are trying to do is to select winners. It looks as if it's the same thing, but it's not the same thing. You are trying to select winners in the equity side. On the bond side, you're trying to avoid losers, right? Also, your return you're expecting in this stock space is your dividends, capital appreciation. You bought at 20 naira, it's not 200. That's 10x. So that's what you look at in that space. We look at tools like real estate. Yeah, there are a couple of research that talk about debt capital. Do that very gigantic or somewhere far away, no access road, it's just locked in there, no returns, no income on that thing, just sitting there. And real estate, the more it sits, the more it depreciates, right? So for real estate, you want to think around, where am I deploying this capital? It is safe, a lot of conversation around demolitions and the rest. So those are the peculiarities of each of these instruments that you need to take into consideration before deploying those capitals. So these instruments, they look alike, but they are different characteristics.
Oh, in case you're joining us now, it's Money Talks. And Money Talks is brought to you by CFA Society Nigeria. Clearly, you can see it's a financial literacy program. The aim of this program is to educate the listener in finance, so you can know how to make informed decisions, whether you're making investment or you are trying to play in the financial sector. You can call us on the telephone. You have questions for my guest. Abiola Hammed is the guest on the program this evening, and we're discussing here capital allocation for retail investors. Right way to think about your money, investments, and credit. So if you have questions about how to deal with your money, how to deal with investment, and how to handle credit, you can call us on the telephone 0700 923 923 923. That's 0700 923 923 923, or you can send us messages on WhatsApp 0817 313 6193. That's 0817 313 6193. You can also record a voice note and send to us to that number, and we'll be talking to you here. Abiola is here to answer your questions for free, as long as he is in our studio right here. So Abiola, this is a question from Godwin, and Godwin is sending us a message on WhatsApp here. He says, the parachute and the risk tolerance you're talking about, does it differ from insurance? Whether or not it does, is this why Nigerians are afraid to take insurance?
Okay, so insurance is one of the tools you can use as parachute for your investment, right? Insurance, derivatives product, a lot of those. In terms of how Nigerians are averse to insurance, a lot of conversation are in there. We are a lot of faith-based country. We rather do the insurance with God, right?
I cover my vehicle with the blood of Jesus.
Exactly.
Angels on God. I'd rather buy a sticker.
I have a friend that does that. That's one part. And also, a lot of times people part with this money. Premium you need to pay upfront, and probably think, hey, why collect this amount of money upfront? But insurance is one of those products. It's better for you to have it and not use it than when you need it, it's not there for you. So it's in terms of aversion of Nigerians to insurance, I think around our faith, we are more inclined to using faith to cover a lot of all of this.
Or is this an elitist thing to say you have to be a big boy to pay that premium? Like you bought a car, regardless of the amount, you put a third-party insurance on a car you bought for like maybe 10 million naira. They put 12,000 naira insurance on it.
You can do the mathematics, right? So if I have that amount of money to pay 10 million for a car, how much is the 5% that insurance will ask for a comprehensive insurance, right? And a lot of these insurance companies are so very innovative now. They are giving you a rebate if you have not claimed any money for about 2 years period. So holistically, and that's another conversation around people estimation of cost and your risk. So you want to put 10 million car on Lagos Road covered.
The number to call 0700-923-923-923. There's also 0817-313-6193. You can send WhatsApp messages there or record voice notes and send there. While we're waiting for your call, Abiola, how then should retail investors assess their risk tolerance now? And how does that impact their capital allocation decisions?
Okay, yes. So in assessment of your risk tolerance, also it's a personal journey. So there are two buckets that fit into your total risk, right? You have the risk capacity. Risk capacity is your capacity to take on risk. So risk basically is a chance of adverse events occurring, right? So those tail risk. So capacity means something. A young individual, you have 30 years investment horizon. That is how long you want before your retirement, like you said earlier, right? So if there's a decline in this 10 million portfolio for the first 5 years, well, you are not retired yet. You can still live on your current income. So that's the capacity to take risk. The other one is the risk appetite. That's your willingness to take those risks. So a lot of people are actually risk seeking. So individuals that are willing to do those large bet calls. Right? But in assessing those two things, what drives the actual risk tolerance number that will give to individuals is your capacity. No matter how willing you want to take risk, if you are 60-year-old, I wouldn't make some investment, put your investment in your portfolio because you don't have capacity to actually withstand the decline or wait for that decline to recover. So, look at your capacity and also your appetite in your risk tolerance. But capacity should be the number one consideration even before your appetite.
Another message here. This is Pascal from Surulere, and Pascal says, "Hello, Abiola. Please, how do you reconcile the current situation in the economy as how it affects investments that you're talking about?"
Yeah, so the economy right now is in a lot of flux. A lot of things are changing, and what happens in the situation where a lot of things are changing is that there's opportunity, right? And this then the call on all to say what are the opportunities in this changing environment, and you can leverage upon and actually build something on, right? In a very uncertain, also the Nigerian market also give you that there's a premium on those uncertainty that we see in this market, and which can give you a size. So a typical government instrument in Nigeria is around 27, 26, whereby that's the premium consideration or for the risk that you have in this environment. So this kind of thing is what you should make your assessment on. And also for investment in Nigeria, it's something you need to have a full consideration. So it's not just about the numbers. If the numbers is studying the economics of it, but you need to understand the political space. You need to understand the legal structure of everything that runs it. So it's just not out of your textbook thing. Things here, you have to have that streetwise knowledge to actually run up those things.
Yeah. Another message here. Our listeners are engaging on WhatsApp today. Another message here. This is Ify. Ify is listening from New Jersey in the US. Ify says, "Hi Abiola, don't you think the low interest rates in Nigeria presently would discourage people from investing their money, given the fact that it actually takes high interest rates to borrow money from same banks?"
Okay,
so it's not balancing. If I want to borrow money from a bank, the interest is very high.
Yes.
But if I tell them I have money to invest, they start telling me kobo. So what do you reconcile that?
So it is the instrument you are trying to invest your money in. You are putting your money in savings account. In fact, that 7% that they are offering you might end up losing it, because once you draw on that account 3 times in a month, it's gone. Right? It's the instrument you are investing in, and that's why we look about instrument. Part of the instrument you can actually invest in is these collective investment schemes, the mutual fund, the fixed income fund. They give you higher interest rate compared to the normal savings account. So you put your money in savings account, credit account, you probably expect nothing, because that's kind of instrument. The banks will try to tell you, hey, we are paying CRR, we are doing this, we are doing all of that. But it is the instrument you need to consider as an investor, and that's why we talk about the instrument and the vehicles you want to use to achieve your wealth. You want to achieve a particular wealth that will need like 15 to 20% return. Definitely, don't use savings account. You don't get it there. So, instrument, you have to think through the vehicles through which you want to achieve your financial prosperity or freedom.
But access to those funds becomes limited if you take it away from savings accounts, where you can just randomly walk into your bank branch with a sheet of paper across the counter. You have your money, but when you invest it, emergencies come, you don't have access to the money.
Yeah, that's part of the consideration you need to make. See, once you are investing, you have this money to invest. You first want to consider your horizon. how long can I put this money away without needing it? Then also you then have the emergency pocket. That money will be your savings account. That is not the bulk of the money, but it's one that in case there's an emergency, you want to have that kind. So that provide that liquidity support for whatever it is you are doing. But the money that needs to actually achieve this money, so you have your portfolio construction. You can have this core and satellite. Core is the bulk money that need to achieve this goal. Then you have the satellite that is doing risk taking, chasing returns for you, right? So the kind of build up of your portfolio is what actually helps you to manage liquidity and also helps you achieve the returns that you are looking for.
And right here, this writer on WhatsApp again says, "Thank you, Abiola, for taking our time to share from your wealth of experience. My question is, as a layperson in finance, what is the main indices to a good investment, or what things should I be looking out for before making a choice?"
Yes, we said it is personal. First, how long is, like, talk about the investment horizon. How long will I be able to put this money away? Also, we want to consider what is this return that this instrument is promising. A lot of times retail investors fall into this trap. You are chasing returns and you don't consider that the return of the principal itself is more important. So because of 30%, you lose out the 100% principal. So very important. What risk am I stepping into? So understand that, and does it align with my own risk? Then layer that parachute, talk about that. As I'm deploying this capital, what kind of parachute can I put in there? So if it's to be some company I'm giving the money to, can I get some backstop from their bank in terms of bank guarantee for this money? Right? If it's some products, can I layer on top of it insurance on those products? So those are the conversations we need to talk about. If I want to do a farm, right, I want to deploy my money in probably a farm. Probably I want to have insurance cover the yield. I want to have a fixed asset. Insurance will actually cover those properties. So those are the parachute talk about layering and covering your investment like a nest egg, not just let it go into the open air.
And as we begin to wrap up, Abiola, could you tell us what are the potential risks of using credit to invest, and how should retail investors balance managing debt with pursuing investment opportunities?
Yeah, so it's interesting, right? Credit is very interesting in terms of when you use that credit to invest. Credit gives you leverage. The traditional computation of return to you as an equity holder is the return on the asset multiplied by the financial leverage you deploy. So if you don't leverage 4 times, so if the asset itself yields 20%, what comes to you as an equity holder is at 80% because you have leverage upon that. That is if everything is going on your side. If it switches on you, leverage can wipe you out in a twinkle of an eye. So right, it's a tool that can go left or go south, right?
Because that's other people's money.
That's other people's money that are contract based, right? And what happens on this side is a contract. We have to return the interest and also the principal. So that's how you think about it. And also for debt, for credit in this space, think about it in 2 portfolio. First portfolio is the debt portfolio, which is probably cost of fund 10%. Then you have to think around it. What investment am I going to put this money in that will yield more than 10%? Because it is the margin over that 10% that comes to you as a spread. Because if it yields 12%, that means you give the lender that gave you that money 10% and you keep 2% for yourself. And also then, what kind of investment do you deploy borrowed funds in? You can take a cue from corporate. When corporate comes to you, that's give me loan. These are mature companies, they have existing cash flows. A typical company that doesn't have a promised cash flow will probably want to come to you for equity, so that if it goes out, we are all in this together. So also, if you are deploying credit for investment, you think around investment that are a bit guaranteed, even though they are not a lot of. So you think around federal government bonds. If you have a cheap fund, I know a lot of places like cooperatives, they give very cheap fund. Those kind of money is not what you do risk with, because they are borrowed funds. They will come for it, right? And the first rule is, if you are in a hole, stop digging. So find a place to say, this is stop loss for me. So if I've lost this money, probably I'll stop. Yes. And also another backstop in terms of let me have other inflows, other income, that if this should go south, I have some money to even pay back. So because creditor will come for the share.
You don't put all your eggs in one basket.
Exactly.
So Abiola, to wrap up, this is the last question because of time. when deploying this capital, sometimes investors make mistakes.
Yes.
Can you just, in a couple of minutes, just walk us through those common mistakes that you've seen in your career that retail investors make as they're moving capital here and there in search of high return for their investments?
Yes, we'll talk about one, chasing returns and risking your principal. That's extreme. And another one is when you don't understand what you're investing in. It's disheartening. You want to, probably you've been a banker all your life, then you are retiring with this pot of money, you want to start a farm. You've not done farm before, right? So that kind of conversation is what you want to invest in your domain of knowledge, right? Just so you are secured in that aspect. Also, you want to cash flow is also very important. So we talk about how long can I keep this money away? Because if you buy those assets, buy those stocks, they are good stocks, right? 20 naira, 200 naira. But then you don't consider your own cash flow. So you bought them today, tomorrow you need money. But hey, if there's decline over those 2 days, you have to sell at a loss, even though these stocks will probably recover in the next 5 days, right? So that horizon and cash flow matching. Another thing is around the money that I'm investing. You have to match it with the right instrument, right? Things around, okay, I've got this pot of money, I wouldn't need it for the next 1 year. Okay, so in this kind of thing, I can do equity, because even if there's a decline over 4-6 months, I could recover before the time I will actually need this money. I'm pressing for this money, because if you don't consider those things, you might actually end up selling at a loss, right? And like we said, if I'm in a hole, I stop digging. Sometimes you want to cut your losses, right? Have that humility to say this is not working, and that's why it comes around the measurement and assessment of my investment. If it's not working, I would rather just take a loss and move on.
Abiola Hammed, CFA, has been my guest on the program Money Talks by CFA Society Nigeria this evening, and he's been talking to us about capital allocation for retail investors, right way to think about your money, investments and credit. Abiola, thank you so much indeed for your time on the program this evening. We've enjoyed this education. It's like an MSc class.
Thank you so much, Matt.
I enjoyed it, and we look forward to having you again soon on the program. That's how we're going to call it a wrap this evening on Money Talks. Remember that you can follow up the conversation or keep in touch with us on our social media handles. First, from our website, www.cfasocietyng.org. You can also check us out on YouTube, LinkedIn, Facebook, on X. It's at CFS Society NG, and you'll be interacting. Till we'll come your way again next time, we'll ask you to keep making informed decisions about your finances. Of course, with CFA, we're making finances a force for good. Thank you for listening. Smart Uzechi is my name. Have a good evening.
Thank you for joining us on this episode of Money Talks, hosted by the CFA Society Nigeria. Stay connected with us on Instagram, Facebook, LinkedIn, X, and YouTube at CFA Society Nigeria. Follow us for more financial insight and updates. Keep a date with us next time.